To understand cryptocurrency at a deeper level, it is useful to compare it with traditional financial systems. These systems are not just about money, but about how value is stored, transferred, and trusted. Let's begin with transaction structure. In traditional finance, a single payment often passes through multiple layers. This can include a commercial bank, a clearing system, and sometimes a central bank. As a result, settlement can take time, especially for cross-border transactions. Fees and processing delays are common. Now compare this with cryptocurrency. In crypto networks, transactions are broadcast directly to the system. They are verified through a consensus process and recorded on a shared ledger. This reduces the need for centralized clearing. It also allows transactions to occur without a single controlling authority. Now consider trust. Traditional finance relies on institutional trust. Users depend on banks and regulators to ensure that the system operates correctly. This trust is supported by legal frameworks and oversight. In cryptocurrency, trust is based on cryptographic verification. The system is designed so that participants rely on code rather than institutions. This represents a shift in how trust is established. Now consider monetary policy. In traditional systems, central banks manage the money supply. They adjust interest rates and respond to economic conditions. For example, during the 2008 financial crisis, central banks increased liquidity to stabilize markets. This flexibility allows the system to respond to shocks. Now compare this with Bitcoin. Bitcoin follows a fixed issuance schedule. The total supply is limited to 21 million units. New supply is introduced at a decreasing rate over time. This creates a rules-based system with limited flexibility. Now consider liquidity. In traditional finance, liquidity is influenced by credit creation and monetary policy. Banks can expand lending, which increases money supply. This supports economic activity, but can also introduce systemic risk. In cryptocurrency markets, liquidity depends more directly on investor capital. It is influenced by external conditions such as interest rates and global capital flows. This makes crypto highly sensitive to macroeconomic changes. Now consider risk. Traditional systems include mechanisms for protection. Deposits may be insured, and transactions can sometimes be reversed. Institutions are also subject to regulation and oversight. In cryptocurrency, these protections are limited. If assets are lost due to key mismanagement, recovery is often not possible. This shifts responsibility to the individual user. Now consider governance. Traditional finance operates within established legal structures. Decisions are made by institutions with defined authority. In cryptocurrency, governance can be decentralized. Changes to the system may require agreement across the network. This can increase transparency, but may reduce speed of decision-making. Now step back and compare the two systems. Traditional finance emphasizes stability, regulation, and flexibility. Cryptocurrency emphasizes transparency, decentralization, and fixed rules. Each system has strengths and limitations. From an economic perspective, they are not direct replacements. They represent different approaches to managing trust and value. In summary, cryptocurrency is not simply a new type of asset. It is an alternative model of financial infrastructure. Understanding this distinction helps clarify both the opportunities and the risks, and it provides a framework for how these systems may evolve in the future.